Hello.
Hello, everybody. Good
All
morning,
right.
good afternoon.
Good morning. It's morning for me still.
Hello, everybody. Good morning, good afternoon.
Jake, how you doing?
Hello, everybody. Good morning. So I had the actual stream up and this, so I was wondering why there was an echo. But anyways, I'm doing great. How are you?
I'm doing great. Last week, just so everyone knows, we did not have Jake here for the live stream, and this week Jake is back. So there was a lot of interesting things, to say the least, that happened in the stock market over the past week. I mean, we had the Fed report that inflation is being stubborn. It's not really coming down. It's still, we still have some inflation going on. FedEx released their preliminary Q1 2023 results and basically said that they're not going to hit their 2023 guidance and that the global economy is slowing down, which caused, a lot of stocks to fall. FedEx was down like 20 something percent, I believe. So there's a lot that happened in the market this week, and we're just going to kind of talk about it today. And yeah, so what do you think about everything going on, Jake? I know you were doing some research on FedEx over the past couple of days. So just really quick, what are your thoughts?
It's really interesting to me because I feel that there is a big battle of mindsets of investors where, not to oversimplify things, but you have people who look at the macro, what's the Fed doing? What are these broader things going on in the economy? And like, how can I time my trades around that? Which also includes guidance from companies like FedEx. The other side of this, which dare I say might be a little bit more where we tend to lie, is and kind of the Warren Buffett mindset is, okay, all this hoopla is going on all the time, but if you pick very sound fundamental businesses and stick with them thick and through over time, things like this, when you look back, don't seem as big as they are right now. However, it's hard to feel that when I'm seeing all these headlines come out about FedEx. I know people look at Visa earnings and stuff like that too, which isn't what we're talking about here, but same thing where it's like, our consumers spending a lot on credit cards, and it's basically people playing games, right? Like, how can we use this data to determine how the economy is going? So I'm happy to pick apart some of those points because there's no right or wrong. It's kind of, what type of investor are you, and what are your goals? So
Yeah, I agree. And I was taking a look at the FedEx numbers last night before I went to bed because I do that for fun for some reason. And honestly, like, my initial reaction was that the numbers aren't that bad. Like, you know what? Um I'm gonna pull up FedEx's numbers because I want to go and take a look at this.
yeah, whatever the easiest. I did send you some screenshots if you want to share a screen on the Discord one-on-one. We have their actual, if you go to their investor relations website, their legit report, so not Yahoo Finances or Bloomberg's interpretation, like
Yep.
literally what FedEx put out.
Yeah, and by the way, everyone, whenever there's major news that comes out with like FedEx, what they did, exactly what Jake just said, you're gonna see companies like Yahoo Finance or like the Motley Fool or whatever putting their own spin on it, probably trying to sell you a lot of fear. So what I do is I always just go right over to the company's own investor relations page and I take a look at, okay, what did they actually say? Like, what is the company themselves saying? What are, not what is everyone else's interpretation, which is kind of ironic because I'm going to give you my interpretation right now.
Yes, and I like having these conversations because I find that the points of view of people like us, who I feel like we relate to a lot of people in the audience here as well, just everyday retail investors, our voices aren't always really heard over the hoopla of media companies just using this as a money-making engine, and you can't blame them. But to build on what you said, Motley Fool, not only will they put out their point of view, there'll be hundreds of their points of views from their different authors. So depending on which article you read, they'll say, people are overreacting, like all of FedEx's business is just going to UPS. You'll read another article from Motley Fool that says 20% crash incoming, sell everything and run under a rock. So it's like, who do you trust?
Yeah, I agree. Okay, Jake, I can't find this for some reason. I see your screenshot that you sent me, but I want like the actual in-depth report because there's a little bit more information in there.
I'm going to open up their report and I'll send you a link right now, but it's very nice. They list out the revenue, operating income, and basically show you some of the spread there.
Yeah, so if I could get that link sent over, I don't know why I can't find it right now for some reason.
I just got it. So if anyone's following along, and this is actually really good advice for anyone watching, I actually have my own TikTok account where I put this on there. So if you want to follow me there, Jake Ruth Official. But if you're not, you can take the company's name and plug it into Google and then type in the words investor relation. And you should be able to see straight from the company's source all their investor communications. More simply worded, any company that is public on the stock market has an investor relations portion of their website. And you can go there to find where they're posting their financial reports and actual letters to shareholders. This is really good to get to the source of the truth and to kind of avoid all the hoopla from the different media companies that will spin off and write their own words that are really just their own opinions and rewordings on top of the source truth.
Okay, so Jake sent me FedEx's preliminary first quarter financial results. And this is really the report right here that tanked the market and sent FedEx stock down like 20-something% on Friday yesterday. So right here, fiscal 2023 is on the left side. We have fiscal 2022 on the right-hand side. And we can see that revenue for this year is projected to be about 23.2 billion, and last year it was 22 billion. So FedEx's revenue is still growing, and it's growing by, that's about 5.6% or something like that. So revenue is actually still up year over year. Then we can see the operating income, and this I think is why everyone was so worried about what's going on, because FedEx is expecting their operating income to be about 1.2 billion, which is down about, what would that be, like 15% year over year. So operating income, so profits are going down. And this is the exact same story with the earnings per share. Earnings per share is actually down about 20-something%. So revenue's growing, but profitability looks like it is being harmed. And then they basically say,
one thing to interject there that stuck out to me is everyone focuses on revenue growth. And I know in your videos you talk about that a lot, but this seems like a classic example to me. And to be clear, it's not a trend. Maybe this is a one-time thing, but sure, their revenue's going up, but they're less profitable. So they're spending more, way more than they did the previous quarter. So yeah, that is concerning to see.
yeah, and then right here they have their FedEx. They have like the different areas of the business. So their FedEx Express revenue is flat year over year. Operating income is down by about 5%. What's interesting though, FedEx Ground operating income is up. FedEx Freight operating income is way up. Okay. So that area of the business is actually making a lot more money. It just looks like basically, yeah, I mean, I don't know. Different areas of the business are still making money. And I mean, this overall business is still making money. And I believe that somewhere in this report, they said that they're still planning on repurchasing shares. So it looks like profits are going down year over year, but the company's still making money. Like they're not going out of business. So it's just, it's kind of interesting. Definitely interesting to watch.
Oh yeah, and I guess as we kind of like peel back the layers of the onions here, I think there's a lot more than meets the eye about this report. So I gave that a full read this morning. What we won't go through here, just because it gets a little dry, is they do line item all the reasons why things are getting kind of messed up. Still some lingering COVID concerns, things as specific as the airplanes busing in airports are they're having like constraint issues on their access to those planes and how long that they can stay at the airport.
Yeah.
So very weird things. So going a layer deeper here and actually asking ourselves, like, what does this mean? Well, I'll put out a few different viewpoints and I'd love to hear your opinion on them. I will say these not from my own, but just what I've gathered on the internet. The first viewpoint is, if FedEx is seeing a slowdown in shipping, that means that less people are buying stuff, which means that consumer spending is going down. We know that consumer spending drives the economy. And when people spend less, that means companies make less money. That in turn affects their stocks, which affects layoffs. And then you start having that, kind of like runaway train where people say, oh my gosh, we're going to a recession. That's one viewpoint. Another viewpoint is FedEx business sucks and they're just losing their business to UPS. Farther, you can make some very long-term predictions. And again, not my opinions, just putting forth the other viewpoint that their business is not really a moat anymore and may slowly die. You have Amazon piloting drone delivery. We have technological advancements as well as freight still going around, which are huge. So you have to ask yourself, Is FedEx still able to compete with UPS, Amazon, maybe new startups that are going to come disrupt the space? Are they able to be nimble? Because sure, they are still making revenue. This business isn't going out of business, but as a shareholder in a company, I want to see growth and I want to see dividends. Since they don't know what the future is like, do they still have the people working at that company that can compete and drive that growth? I'll withhold my opinion for now. I'd love to hear yours, but those were kind of the bigger ones I saw like sloshing around the internet.
I was going to say kind of the same thing. Like what I'm going to be interested in is UPS earnings versus FedEx, and then also Amazon earnings versus FedEx, because what I'm kind of seeing right now is everyone is saying like, well, not everyone, but a lot of people, a lot of the media that I'm seeing right now is like, okay, FedEx is basically predicting that we're in a recession, but are we? Like, or is that just FedEx's business losing market share to Amazon or more companies? You know, like we don't know yet. So, yeah, just kind of definitely interesting. It's also interesting to me that like a $40 billion company can wipe out, you know, trillions of dollars from the stock market. It's crazy.
The cascading effect is nuts, and it almost feels that there's so much uncertainty in the air for the financial climate we're in. You know, obviously, COVID really shook the boat. There was lots of stimulus. There's rate cuts, rates coming back up. People are trying to say,
Yeah.
"Oh, this is just like this prior year." So people are looking for something, and it seems maybe there was an overreaction here. Maybe it was an underreaction. I guess time will tell.
Lincoln Woods here says, my takeaway from the FedEx news is that people are returning to retail / in-person shopping. I expect to see renewed strength in companies with that sales structure. I would agree. I mean, you know, over the past couple of years, especially during the peak of COVID, I mean, we basically were forced to shop online. Like I know for me in Canada, like I legit couldn't, you know, go to stores. I had to order. So FedEx, Amazon, all those businesses definitely saw a massive boost from, you know, just the environment that we were in. And now it looks like, you know, people are returning to back in sales or in-person shopping, which is exactly what Lincoln is saying here. So the companies that would be seeing, or sorry, the companies that would see renewed strength there would be like the actual retail locations, maybe even like the real estate companies that own these, you know, brick and mortar stores. Maybe they're going to see a boost. Who knows?
Yeah, it's a really interesting one. One thing I want to look at, and I haven't been able to pull up the data for it, but I do remember seeing a graph. I'm not sure how they pulled this data, but it shows consumer savings. And from what I recall, after stimulus checks came through and things like that, Americans specifically were sitting on almost a record number of personal savings. In other words, this is just the amount of money people have saved up. So what I'm curious about is we saw the traveling boom, we saw everything rebound back. You don't need to be a rocket science to kind of understand the human behavior where, you know, you're bunkered down for over a year. And then once those restrictions kind of lift, we're all butterflies kind of like flying around, splashy cash, all that. I'm curious where those savings are now. Like, did we run through those? And on top of that, inflation is hitting most of America's homes, both from food cost, price of gas went up for a while. So again, it is hard to make sense of all the different inputs going on here, but the more macro argument to be made there is people don't have as much money to spend. They are now needing to spend more on essentials like food and things like that. And, you know, FedEx for me, like if I get a FedEx package, that's usually a for fun thing or a gift. It's usually not a package of celery or toothpaste. So it would be interesting to see, you know, like does FedEx as a company have certain types of things that they ship relative to other companies that ship, right? Like maybe Amazon does more of the day-to-day things that you need and FedEx is more of a gift one. I'm not sure. We would have to dig pretty deep for that data.
Yeah, I agree. I'm just taking a look now at FedEx because I mean, man, that is that is a that is a big freaking drop right there.
Yeah.
So
I'm
I
curious
mean,
what their operating margin is since we saw like their revenue and operating gap widen. So I'm curious if that's a trend that had actually been going on for a while or if that's kind of potentially an argument for like a short-term thing where a FedEx bull here might say, hey, this is a perfect buying opportunity because the people are wrong who say that they're going out of business and they're actually going to continue to grow profitability and revenue.
I mean, they do like their operating margin is 7%, operating cash flow margin is 10.5%. Not awful. Let's take a look at their revenue growth.
I'd be interested to compare this to UPS as well.
Yeah, let's do it. UPS. I imagine their ticker is UPS. Let's go.
Yeah, and for all those tuning in right now, if you're not aware, we are both co-founders of a company called Stock Unlock, which is the name of the channel. We are using the Freeform tool right now. It's free to make an account, free to try, no credit card. So if you haven't taken a look at this yet, this is a great tool that has over 80 financial metrics that you could graph 20 plus years back in time and compare against as many companies as you'd like. If you're a new investor, it'll take you a little bit to get your feet wet here, but this has saved us a lot of time. So if you're curious on checking this out, head over to stockunlock.com.
Awesome. So to my surprise, FedEx is actually growing its revenue faster than UPS. And we can see right here that both these companies had this drop in revenue during the Great Recession, which kind of makes sense. But I mean, both these companies are still growing. Revenue is at an all-time high, but let's take a look at operating cash flow. Okay, FedEx is growing operating cash flow more rapidly, but holy crap, dude, take a look at how wild the profits are for these businesses. Like, these are not, in my opinion, predictable and stable businesses over the long term, man. Look at that. I mean, UPS was generating $8 billion in operating cash flow in 2015, and then by 2017 it dropped to 1.5 billion. That's like a 70 to 80% drop in operating cash flow over 2 years. Crazy. So yeah, it looks like, I don't know, these businesses just are volatile. They have, swings in profitability, and that's just kind of what it is.
Yeah.
Anyways.
I was going to say, if anyone in the chat has any comments or last topics here for the FedEx thing, we'd love to hear it. I do think that we also had the Figma Adobe acquisition on the table too.
Okay, yeah, the Figma Adobe acquisition, that is just crazy. I'm gonna
get time for me to grab a quick glass of water. I'll be back in a sec.
All right. So prior to getting Stock Unlock, there wasn't any great way to access all financial metrics and compare companies. Thank you for that iteration. I mean, if you guys don't know, I have a YouTube channel with about 200,000 subscribers where I just do stock analysis, and I've been doing that for a few years. And man, it was hard to, get all this information in an accurate way and like display it and compare companies. It's a large part of the reason why we actually made Stock Unlock, is just to save myself time. So it's great that it's saving you time as well. So hello folks, got a question. Do you still need to pay taxes on capital gains on stocks you profit from if your portfolio is at a net loss for the year, assuming it's short-term, held under 1 year? I'm not a tax expert, but I believe that, for example, like if you took a $20,000 loss on a company like Alibaba, and then you took a $5,000 profit on a stock like Apple, for example, I don't know, that would mean that your portfolio is net negative 15,000 on the year. So I don't believe that you would have to pay tax on the profit because you still have a net loss on your portfolio. But again, I'm not a tax expert, so please, if someone knows, let us know in the comments there. But that's just my opinion.
Yeah, I don't want to get into the weeds on this. I'm not sure if that's 100%. But I think most simply put, yeah, we are not tax professionals, but we're very happy to send you to someone offline. I think that each trade is individual, so you are allowed to wash, I think, up to 3 to 5K in the US of losses. But if you made $100,000 on a trade short term, you pay tax on that. It doesn't matter if you lost $20 billion somewhere else. But
okay. Moral of the story here is,
don't trust us about tax things. We're here to talk about stocks, again, just from our personal experience. We would love to reach out to you after this, though.
I've been nibbling UPS, not touching FedEx by any means. Too much uncertainty. So you think there's more certainty in UPS than FedEx, basically, is what you're saying. Interesting. Cutting guidance and insider selling all over the past month when FedEx said things were looking great 3 months ago. I can't put any stock in management. Yeah, I mean, you got to really focus on the management when you're investing as well. Let me actually just share my screen again, and let's go take a look at the insider selling on FedEx. But while I'm doing this, Jake, what do you think about the Adobe Figma acquisition? Because we're actually users of Figma. I mean, Stock Unlock is designed on Figma. So yeah, what do you think about that?
I am super excited. I have a lot of thoughts just off the bat, but I am super excited to talk about this for a handful of reasons. One, this is private markets, and typically in Stock Unlock, we talk about public market investing. But there is a lot of really cool things that goes into private equity that I'll talk about a bit here. We actually have some exposure to this where we can't give the full terms on this live stream, but Stock and Lock is an incorporated company in Delaware. We did go through Y Combinator and Raise, so we actually are seeing firsthand how some of this private lending and stuff like that works. So the fact that this isn't a public acquisition is cool. I'd say the second half of it, just so people can learn a little bit more about the angle I come from, I've been a software engineer for almost a decade, and I've worked at a couple companies in the past, running teams, senior eng, all that. And I have used products like Figma and all these. So a big angle I'm looking to get into on this is, strategically, not even diving into the fundamentals of the deal too much, strategically, why does Adobe want this? How can they make money off of it? How will Figma change? And what moat is there, or maybe there isn't, around a product like Figma, where I have a ton of opinions about, how easy or hard it is to copy this tech for someone else to build it. And we might even be able to make some cross ties to the Salesforce acquisition of Slack and what Microsoft did with Microsoft Teams, which I think may play out here with different puppets. So lots to talk about there. And on the surface level, it was a $20 billion acquisition. And I need to double check the facts here. I think that was around 50 times revenue. That I do have to double check that fact. If someone wants to fact check me in the chat, please do.
It was 50 times revenue. It was 50 times revenue. And based on my assumptions, I think it was about 100 times operating cash flow.
Not cheap, but if Adobe is able to grow that top line revenue 4x, that immediately brings down that multiple a lot over the years. And that's what these big companies are thinking about. They care less about the multiple and they say, I'm going to make up these numbers. So let's say Figma is doing, $1 billion in revenue, not their actual number. If Adobe thinks that they can raise that to $4 billion in 4 years with their expertise and product offering, that 50x multiple then gets divided by 4, I believe. So
I was also reading somewhere that someone said Figma long-term could have harmed Adobe's business. So you also have to factor in like the potential losses in market share that Adobe could have experienced over the next, 5-10 years by competing with Figma.
Yeah. And the amount of money it would cost Adobe to build that product would be absolutely immense.
Well, what's also interesting is like Adobe fell, I think it lost over $40 billion now in market cap from this acquisition. So I actually made a video on my main YouTube channel going over this acquisition and going over Adobe, because this is a stock that I had here on my stock unlock watch list. And I was saying, I thought it was too expensive in like the $360, $400 range, and I was waiting for it to come down. Well, now it's down. It's down a lot. And it's really starting to interest me. Full disclosure, I have not bought any shares yet. I'm really considering it. But I mean, at this point, I think Adobe is now trading for 20 times operating cash flow, even when you factor in the dilution that's going to happen. And this is like the cheapest the stock has traded for in, I think, like 9 to 10 years. And it's trading at 19 times operating cash flow now. And over the past 8 years, its average has been 32. So it's selling way below its historical averages now. And what's interesting is now that the stock has dropped $40 billion on this acquisition, it's almost like it's already wiped out all of the risk associated with the Figma acquisition. And it's, in my opinion, an overreaction. Where was I going with that train of thought? Oh, yeah. But now you got to think about this, because Figma is a very profitable business. It has 90% gross margins, which I think is going to translate into probably a 40% free cash flow margin, which is highly profitable. And they're growing revenue at 100% year over year, $400 million in annual revenue now. And this is going to now be added to Adobe. So this is a new growth engine that's growing 100% year over year, hundreds of millions of dollars in revenue, and it's profitable. That's going to be directly added to Adobe's operating cash flow and grow Adobe's business over the long term, most likely. So I think that now existing investors got diluted from this acquisition, which sucks for if you were an existing investor in Adobe. But now new investors, such as myself, are looking at this and saying, well, hey, Adobe now has this new growth engine. It's selling at 19 times operating cash flow. And, the company might have more growth potential now in the future. So for me, as a newer investor looking at Adobe, it looks super interesting. Now, the contrary thing there is there's no way around this. It was a freaking expensive acquisition. And then you got to question the management. Okay, they just did this massive acquisition. I think they're overpaying for it personally. So what are the chances that they're going to overpay for another business in the future?
Exactly.
What,
Yeah, I couldn't agree more. The 20 billion price tag definitely makes you sweat a bit. And I also agree on the note where, if you're a new investor here, it looks great. If you're an existing investor, obviously this was not fun. You just saw your holdings go down, at least relative to where they were before, or maybe watched any gains that you might have already had. Here's one thing I like about this and one thing I don't. And again, for the new viewers, this is coming from someone who's been in software engineering for a while, so I really touch these things a lot. I love this play from a product standpoint. Adobe sells a cloud bundle. They, are famous for Photoshop, things like that. If you want to look at their place in tech, they're kind of niche, in my opinion, like lots of video processing and niche in the context of general software development. So what I mean by that is, Figma kind of goes into the software development branch. There's also like other tools that you'd use to design and create software. And what's interesting about Adobe's offerings right now is I feel like, have been trying to get into that space and haven't really cracked in. Figma really opens that door to a whole new segment of customers where once they're able to upsell existing corporate clients who are using Figma, because tons of corporations are already using Figma, they're going to be able to upsell them on tons of other products that they have. So that's what I do like. It opens a whole new door. And in my personal opinion, software development is a space that continues to expand and grow. And the toolings and service offerings around those, anywhere from cloud infrastructure hosting to the more utility tools like a Figma or developer tools, is just a good angle. Here's the thing I don't like, and this is my classic argument with tech. One, and I don't mean to insult anyone by this because it's applied to myself too, I feel that most people that invest in these companies don't really understand technology, how it's coded, and how easy or hard it may be for other companies to copy each other. So let's talk about Canva for a second, or Canva, someone can correct me. Canva is a really interesting company, and not a lot of people noticed that within the last week, they dropped one of the biggest feature drops I have ever seen from a tech company ever. They basically copied Google Doc sharing features, made it really easy to read and write text from images. They really took a stab, and they were like, we're not just the best, flashiest, now beating Adobe product. We are proving that we have tech team and people working for us and motivated engineers that are slamming out product at a speed that we haven't seen since Google back pre-2010. So if I was Adobe, I would be, really scared right now. And I would really want to ask management what their fears or research was on emerging competitors coming in and taking market share away from Figma. Because the thing I don't like about this is I'm questioning their moat. They have users today, but if they start charging for that and all the free users that are not corporate clients and more of the, rag and tag individuals or contractors, they're going to just find another solution that's 90% as good. And yeah, I see that as a big headwind potentially here. It's going to be really interesting to see if they could keep that market share moving forward on the.
So wait, I'm sorry. Were you just talking about Canva?
Yeah. So if you look at Canva as a company, they the main point there to summarize was there's other software companies that are coming out with product offerings that are completely.
I do agree. And in my personal Discord, one of the main bear thesis or bear arguments, I guess, against Adobe is that, there's even for Photoshop and Premiere Pro, which are the, photo and video editing software that I personally use, people are saying that there's a lot of other options coming on the market now that are like pretty dang good and cheaper. I mean, for example, I pay $60 a month for my Adobe package, which is like it's $720 a year for me to use Adobe, which is not cheap. Yeah, it's not cheap, man. And yeah, so I mean, if there's other products coming out that may be cheaper or free, I mean, it's at the point where I would seriously consider looking at them. So you do got to question Adobe's moat. I mean, right now the stock is as cheap as it's been over the past decade, though. So I mean, it definitely looks interesting, but there are some questions that you got to ask yourself if you're going to look at this company for sure. I mean, question the moat, question the management. For me personally, I think that if the business just did a $20 billion acquisition and paid 50 times revenue for another company, that really does start to question the moat of that company. Like, why are they paying so much for Figma? You know, it's crazy how much they paid. But if anyone has any questions or comments about the Adobe acquisition this week, let us know. I would love to bring the conversation over to you guys watching the stream, and whatever questions you guys have for us, just fire them. We're happy to talk. Also, what was I gonna say? Okay, this person right here, and the name is anonymous, but it's upside down, so you got to look at that upside down. Okay, this anonymous asks AVCT. So I'm gonna quickly take a look at this. I'm gonna share my screen once again.
Awesome. And while you're doing that, I'm going to quickly take a question from Curtis Williams. Any chance for a stock screener? You are with the crowd on this one. We are going to be building a stock screener. And by the end of the year specifically, we are going to have a screener based on our insight scores, which we think is unique value for us that you can't find on other sites. So you'd be able to search stocks based on insight scores, and that's a feature that we're going to keep on building. You can also expect a portfolio tracker to be dropping within the next month or two that we're going to start testing. So those are two really big features that we have been working super hard for all you supporters on. So excited to drop that.
Okay, so this is AVCT. Well, first off, this stock is literally down like 99% over the past year. It's a very small market cap stock. This is my first time taking a look at it, by the way. So I'm going to go to our insights right here. Profitability is 1.4 out of 5. Basically, this company is losing a lot of money. They're not profitable. This is very risky, in my opinion, because when you're investing in a stock or buying a stock, you're buying the actual business behind the stock price. And the business behind the stock price is losing hundreds of millions of dollars, it looks like. Well, sorry, they're losing about $65 million a year right now with very thin margins. So they're not even close to becoming profitable. If we take a look at growth, revenue decreased by 45% over the past year. Free cash flow, net income decreased. So profitability and revenue is going down. Financial health.
Not good.
Financial health, the shares look like they have increased by 1,500%. So you know what? Honestly, this is not a stock I would ever buy. Straight up. Just by taking a look at our insights here really quick, I mean, it's not profitable. It's losing a ton of money. Its revenue is going down. Free cash flow is going down. It looks like it's diluting. It doesn't have a strong balance sheet. It's just a stock. When you're investing in fundamentals, it's a stock I would just personally pass on. That's my opinion.
I think a good summary for me, and this is not financial advice, there's tens of thousands of stocks out there. Maybe I could see someone make a really deep argument that this is going to be the turnaround play of the century. Maybe they got a new CEO. Maybe there was something bad happening in the company. You know, there are real cases where stuff like this happens and it looks like a train wreck. And then very savvy investors who do deep research can find incredible opportunities. That being said, those situations aren't that common. So maybe even if you find one or two things that are good about this stock, I challenge you to look at other stocks where you might even find more things that are better, because there's endless choices out there.
Okay.
And the last thing I would look at there is, you know, they're burning so much money, right? Like, how much money do they have in the bank? What's their burn rate? Are they just getting money from share dilution and stuff? And like, how much longer does that business have until they go bankrupt?
Yeah. So I'm going to follow up on what Jake just said about portfolios, because sneak peek, everyone. This is our portfolio. So by the way, this is a fake portfolio on my personal account. I do not have this much money. I wish. But this is like our dividends tab that we're building out. So you got your yearly, monthly, daily, hourly dividend income, and this is coming to stock unlock for all of you. Then we break down the income by business here over the next year, so you can see exactly where your income is coming from, which stock, the table of all of your income. This is still in the works, by the way.
Yeah, I'm gonna rudely interrupt you here, and this is in a playful, fun manner where this is a very classic engineering product scenario. As an engineer here, huge disclaimer: this is all under development and testing. This is not released. It will be changing a lot. And what you are seeing here is the tip of the iceberg of more greatness to come. So you may be impressed, you may not. Don't judge a book by its cover. And you know that this is something that we're highly iterating over. So please take it back, Daniel. But I needed the little eng disclaimer on that to settle the heart.
a little bit of a different different vibe from last week when I was just like, oh, look at me, I'm showing everyone what we're
Oh,
building.
I watched that. I watched that stream, and I was like, I love you, dude. But yeah, it was a good one. No harm, no foul.
I just want to show people, you know, what we're working on behind the
Dude,
scenes.
please keep doing it. You're supposed to feel uncomfortable at startup, so it's we're right at home here, and I'm not sure we could probably take some of these comments coming in. One I wanted to dip back on just super quick. SM Finance also saw you here the last couple of weeks. Thank you for being here. Really appreciate the support. Don't companies normally overpay when they acquire a company? I feel like that's the cost that comes with buying a company that someone has already built. You are 100% correct, and I appreciate this because we didn't harp on this enough. Yeah, paying 50 times revenue, it is expensive, but you are also right here. That's not completely out of the question. And you can go back in time and find lots of acquisitions like Facebook buying Instagram or WhatsApp. And at the time, it's like, or even Google buying YouTube, it was like, oh, they overpaid, blah, blah, blah. And now 10 years later, they look like geniuses. So the management that bought this company, we can assume that they did a lot more research than any of us did here. So if you trust them and if they think that they're going to be right on their thesis, they probably paid a fair price. I wish I had a crystal ball to see the future there, but that was a great point, SM. Thank you for that.
I agree.
We got some stock recommendations here.
Sorry, Iteration says it's a pretty insane acquisition, massive amounts of money. Management has to be pretty confident. I agree. I mean, the management's got to be very confident if you're spending $20 billion, 50 times revenue, especially in this environment. Like, what's funny to me is in 2021, at the peak of like the speculation bubble, I mean, T-Doc bought Livinggo for like something crazy. I think it was 100 or 200 times revenue or something like that. And the market was like, let's go. Everyone was so happy at 100, 200 times revenue. And now you got Adobe buying Figma at 50 times revenue. And the market's like, sell it, tank the stock, not okay. And it's just like, that is the difference of like a year to 18 months. Like, it's crazy.
I don't mean to be cherry picking comments here, but I'm going to echo something that Lincoln Wood said. Also, hello. Daniel, this is a direct request from me as well. There is a stock called Pool, Pool, and you will be shocked to hear that they sell pools. And I know you like railroad stocks, and I know you like the boring stocks. Pool is one of the stocks where if you look at a top 10 or top 20 list of top grossing stocks since like 2000, we should probably pull this stock up in Stock and Lock right now because this is a business. I get excited about this. You can understand what they do. They have a moat, no pun intended. Great pun. I ruin it when I say it like that, but and yeah, it's easy to understand what they do. They're coming down from a big run up, and I kind of want to quickly spend a week to become an expert on swimming pool companies. Like, how many are there out there? What is their competition? Dude, you think it's funny, but you would not have thought this was funny if I bought this stock back in 2000, because I'd be rich right now, and you'd be laughing on your railroad stock train, which you'd also be doing pretty well on. But
nice pun there again.
Yeah.
Okay, let's take a look. Let's show his percent change here. So this stock is up about, it's over 6,000% since 2000. So yeah, I see what you're saying here. And what I love, why it's funny to me is because it's like, you see this stock up 6,000%, right? Over 6,000% over the past 20 years. How much more boring of a business could you think about? They literally build pools or whatever. They're in the pool industry. That's like an industry you would never just think about when you're thinking about like, okay, what industry do I want to invest in this week? Or what industry do I want to invest in over the next decade? Pools. That's what it is.
If you don't mind, pop up, because I've already done this, pop open their financials tab and go to their income statement and just look at their revenue growth. I know that this is not the whole picture and there's lots more to look here. I'm not reversing on what we said before, but just kind of like check this out though.
Okay, their revenue has gone up by, honestly, it's been about 6x over the past 20 years. Looks like they had a big dip here in a recession. Okay, this is the thing. I've done no research on this business, by the way, but what I inherently think about the pool industry is when people are feeling rich, they're probably like, yeah, let's build a pool. But when we're in a recession, like in 2007 to 2009, you can see the revenue went down because when you're in a recession, people are, more conservative with their cash, with their money. And I mean, if we're in a recession, I would not be like, okay, let's go and build a pool in my backyard.
No more, no diving board, just the pool. You're gonna make a deep end. We're just gonna get the kiddie pool this year. We're gonna go to
Yeah.
Sam's Club, get the blow up pool instead.
But no, seriously, take a look at this. I mean, in 2020, we had that massive stimulus. Everyone was feeling super rich. There was so much cash in the economy. And you can see right here, like, I imagine everyone was feeling rich. You know, we were in like this economic boom essentially, and everyone's like, let's build a frickin' pool. But now if we get into hard times, I'm wondering if we might see something like this again, where revenue starts to, slow down. So far, it does not look like that's the case, by the way. I mean, their last quarter, they just did a record amount of revenue. What is their cash flow like?
Yeah, there's a lot more to look at here to see how profitable they are. But I have to agree, if there's any concern I have with this business, is it's ran a lot. Of course, you can look historically and say it's almost always been a good investment, but you always have to look towards the future. How much growth does the stock have left? Is it fully milked? And I always love this kind of blanket statement argument of what technological disruption might be coming in the next 5 or 10 or 15 years that is going to completely disrupt swimming pool creation technology. I don't know. I wouldn't bet on it. But if I were to be looking to start a position in this company, and of course, from a long-term investor standpoint, those are the questions I'd be asking myself, as well as the, insiders running it, ownership, how long have they been there?
Yeah. So right here, we can see the profitability of this business is average. The free cash flow margin is actually quite low at 2% right now. Also, in the financials tab that we were just looking at, the free cash flow and operating cash flow are declining, which our insights right here say. Free cash flow decreased by 66% while revenue is growing. So for some reason, this business, let's take a look. Actually, yeah, let's take a look at operating cash flow.
Are you trying to say that their swimming pool is drying up?
It looks like it, man. I mean, operating cash flow in the trailing 12 months freaking took a big dive.
Oh, wow. And I mean, their stock price too, I know we were looking at a 20-year chart, but if you shorten that to around 4 or 5 years, that definitely really has nosedived, of course, with the rest of the market. So
but I would
maybe on that.
If I were going to take a deeper look into this business, lots of puns here, man. Great work on our part. But if I were going to take a deeper look into this business, I would really question, why is the revenue absolutely going crazy and spiking while the profitability is falling off a cliff? Like, there's a clear trend here where operating cash flow is going down and revenue is going up. Like, if we just take a look at the operating cash flow margin, I mean, it was 12.3% in 2020, and now it's all the way down to about 2.6%. So the margin of this business seriously fell. What is the gross margin doing? What is going on with this business? The gross margin is taking off.
Let's go to the moon. If anyone's watching and is getting very interested in this, we do have a Stock and Lock Discord, which is free. And if anyone does some more digging here, heads to Pool's investor relations website, maybe digs up some answers here. We'd love to continue this conversation more. Obviously, we're just handling chat conversations right now and are not experts on this business yet. But
yeah, there's some interesting things going on. I mean, revenue's increasing, gross margins increasing, operating margins increasing, but the cash flow margins are going down. So that is just weird. That's going to take some more diving into.
Yeah, it's like, what are they investing in, right? Like, maybe there's something on the horizon that they started getting a ton of money and they're like, this is the right point to make investments, CapEx, all that for future growth. Maybe there's a new technology to build pools with.
I'm going to take another question. This one is about EQB.to, because this is a stock that we've talked about previously. So this stock is now trading for $49 a share. It's a Canadian bank stock. It's a smaller cap Canadian bank stock. That's just coming down. Now, what's super interesting about this business is the insiders are consistently buying shares. Like, as this stock continues coming down, I mean, it's down about 40% from its peak now, and the insiders have bought millions of dollars worth of shares as it continues coming down. I'm personally invested in this business, and I read every single transcript, and the transcripts that I read, the insiders and the management are like, our business is fine. Like, everything under the hood of this company is fine. But I think with everyone thinking that we're entering this massive recession, or like, people saying the economy is super weak, I think people are super bearish and don't want to be invested in the banking sector in specific, because historically when there's a recession, the banking sector does not perform that well. But personally, I still like this company. I am dollar cost averaging this one, especially in this price range. I mean, it's selling below book value now. Its price to book is 0.82, selling below book value. Its earnings yield is 17%. It's got a 2.5% dividend now. And the payout ratio on that 2% dividend is only 10%. So they're using like only 11% of the net income to pay the dividend. So I think it's a very healthy business. I am not worried about that one at all. And just super interesting. Super interesting.
Yeah, I'm seeing some tickers in the chat here that I've never seen before. Just to be fair for the people that started posting up, MTB Thrill Seeker, great name by the way, posted about CLF.
CLF?
New stock. Let's take a quick peek. I think we, what are your thoughts on EQB, WBA? Apologies that we're not getting to all these, everyone. We're going to do our best, but
Cleveland Cliffs Inc. Okay, this is a $7.8 billion company. They are up massively since the COVID crash in 2020. Stock's up about roughly 300%. Free cash flow yield 41%. What is going? Oh, they're a metals and mining company. Okay, interesting. So Cleveland Cliffs flat rolled steel producer, which supplies iron ore. So they're in the steel industry. So they're a commodity-based business, I would imagine. Insights, dividend, profitability, margins.
Look at that growth. Look at that growth score. That is sticking out to me. Usually, I don't see mining companies that grow like this. And if you're still in the chat, MTB, please feel free to drop your own thesis on this.
Yeah. Okay. Shares decreased by 10% over the past year, so they look like they're buying back a ton of shares. I mean, revenue. Everything here is growing. Free cash flow grew by almost 1,000%. Revenue increased by 82%. It looks decently profitable. So let's go to the financials. What is happening here? Okay. So revenue went from 2.5 billion to 24 billion in the past 2 years. So they've 10x'd revenue in 2 years.
Wow.
What? What is happening here? All right, cash flow.
Dude, add it to the watch list. I mean, this lots of digging. Oh my gosh, all the puns. Lots of digging to do on this ore company.
Okay,
I'm gonna get kicked off the stream soon if I keep on dropping puns like that. But
look at this. So net common stock issued in the last 12 months, they've repurchased $1.5 billion worth of common stock. That's a lot. So what does that do to their share count?
Are they just pulling $100 bills out of the ground? I mean,
with the commodity prices spiking right now, I imagine this business is seriously benefiting from commodity price spikes. So, I mean, it looks very interesting, very, very interesting. But I know that the commodity sector is kind of cyclical. So I try to kind of stay away from the commodity sectors, honestly. But this is interesting. You know what? I'm going to make a new watch list right here, and we're going to call this the Stock Unlock live stream watch list.
Nice. And to echo, thank you, MTB, for coming back in the chat here. CLF is a CLF is a growing stick with a low PE ratio. I mean, agree on the growth. And the only thing I haven't looked at is what the average PE is for this industry. I'd want to look at some other companies, but assuming you're right here, this is interesting from a fundamental standpoint. Next steps for me, I'm assuming, Daniel, you too, would be investor relations, management, kind of seeing who their competitors are, like who their customers are, and just making sure that there's a lot of, trust in management and also belief in the continued growth of this company. And, if both those things check off, if the individual investor thinks this is within your risk profile, maybe it's for you, maybe it's not financial advice, of course.
I'm going to head back over to the live stream, and I'm going to post the link right here to the watch list that I just created on all the tickers that we're talking about today.
Nice. Yeah. I shouldn't advertise features like this, but I find one of the features that is a little under the radar for us is sharing a watch list. So you can do this on a free account as well, but all your watch lists are shareable with the public URL. So even if people weren't on Stock Unlock and you wanted to show them stocks you were looking at, you could add notes to them, potential buy or sell targets and things like that. And you can just share it with anyone. They don't need to make an account. We love getting feedback on features as well, too. Support@stockunlock.com, or our Discord is always open. I will likely be responding to you in a very freakishly fast timeline.
Yeah, seriously, all support emails that we get, or like if you guys want to talk to us directly in the Discord, give us feature ideas or feedback. We read every message, okay? Like me, Jake, Nick, or Joel, the people building Stock Unlock, we will respond to you. So you can get in contact with us for sure. SM Finance says, I feel like this is the problem with companies holding too much cash. Buffett said he agrees with dividends instead of compounding within, since when companies have so much cash, they tend to be careless. Yeah, I mean, too much cash on the balance sheet is interesting. It's an interesting argument because, especially in high inflationary times, that cash on the balance sheet is depreciating, and then management almost feels pressured to do something with that cash. And it's interesting. I don't think that there's one answer there on if a company should hold a lot of cash or not. I mean, Berkshire was holding 150 billion at one point, and that company's outperforming almost everything. So yeah, it's an interesting argument.
Yeah, I would say it depends. I'm also looking. We are coming up on an hour, which is amazing. I think we have about maybe like 5 or so-ish minutes. We might have time for 1 or 2 more stocks in the chat. There's a handful of them up there. So
yeah, Jake, I'll take a look at some more stocks. Do you want to get everyone the link to our Discord? I'm seeing some Lincoln here, for example, said he'd love to join. Yeah, so if you could shoot the Discord link in the chat here, that'd be great.
Oh yeah, I sent it above. I'll send it once more for the.
Oh, you already did. Sorry, you're ahead of me.
Dude, it's all good. I always find it as a fun skill to keep up with live stream chats. It's like this happy like gray area medium is like trying to read all the messages while still being engaged and
this
talking.
Iteration. By the way, Iteration, thank you for all of your comments today. I love talking. Daniel, I know you've talked about INMD before. Do you see yourself owning it? Has some of the best fundamentals I've seen of any company, just don't know how sustainable it is long term. So INMD, this was a company that I talked about. I'll share my screen again.
Yeah, we get that one a lot. I feel like I get asked that a lot on my TikTok account a lot as well, to do analyses on that company.
Yeah, so INMD, I mean, on my main channel, I think I was talking about this one when it was like $22 to $23. It's now up quite significantly. Unfortunately, I never bought this one. It's got an insight score of 4.83 out of 5, though. That's like honestly one of the highest I've ever seen.
I agree.
Profitable. Very profitable. All of its margins are insane. Free cash flow margin is 45%. Growth is insane. Revenue increased by 40%. Free cash flow 27%. Financial health is insane. Debt free. They're buying back shares. They have more cash than total liabilities. I mean, look at this. Everything about this business says it's good or very good. It's just wild.
Is it too good to be true? Can we go to the insider tab? I'm curious if there's any like selling, not to like try to look for something wrong. Oh, this is actually okay, a little bit of selling, but
no, but this was all the way back in 2012. So I mean, recently insiders are not doing very much with this business.
Good catch, good catch.
I was reading, so I mean, in the trailing 12 months, this business's revenue is just increasing very nicely. But I believe this is the thing right here. And by the way, I try really hard to find negatives about this business. Okay, so I'm being like super picky. The one thing that I noticed, okay, is the operating cash flow did decrease, or sorry, it increased, but only slightly in the trailing 12 months now in their most recent quarter, whereas the revenue is still increasing quite significantly. So it looks like their cash flow margins may start decreasing. And the reason I did not invest in this business is because I don't know a lot about the industry that it's in. It's in the plastic surgery industry. And I believe that the management themselves said that this industry is easy to break into. So what that means for me is I don't know if this business has a strong moat. Like right now, they're growing super well. Everything is going great. But when the management themselves says like a competitor could easily come in this market and like take market share or harm our margins, when I think 10 years out, I'm like, I don't know if I love that.
Yeah.
So that was like the main reason I did not buy INMD, is just simply because the management was like, we don't know if we have a moat.
Yeah, you're hitting the nail on the head there for me, which is one of the biggest things I ask myself whenever I'm looking at a stock is what is their moat? And it's a double-edged sword because we were actually talking about this at the beginning of the show for those of you who are with us about the Figma acquisition, because it was like, okay, Figma's great, but how hard is it for a Canva or a Google or someone to come around and come up with a very competitive similar product? My opinion as a software engineer, it's not extremely hard. I actually think it would be a lot easier than someone coming in and copying the pool company we talked about, where I'd imagine it's a lot harder to build countrywide infrastructure to build swimming pools at that scale, because it's not software, it's a lot of hardware. And tying that back to Stock Unlock, there's a lot of huge, bigger incumbents out there, huge brokerages, things like that. And with where the world is today for how easy or hard it is to spin up new software financial products, I think that a lot of those companies are ripe for disruption too. Am I trying to trade or invest around that? No. But when you have a company like this plastic surgery one that goes up, you best believe that there's hundreds and hundreds and hundreds of eyes from venture capitalist firms and other entrepreneurs who are just salivating, looking at that and like trying to get a piece. So the bigger that stock flies, I think the more attack vectors they'll have exposed to them for other companies trying to take their business. And it's just something to watch out for. Will they be able to stay on top? I don't know.
Yeah. And here's the thing too, is I was reading The Intelligent Investor. I've been reading the chapter on margin of safety for probably the past week. And it doesn't take me that long to read a chapter of the book. But the reason it's taking me so long is because I'm like studying a lot. Like I'm taking notes, I'm highlighting things. It's wild because I really want to understand margin of safety. And basically margin of safety in investing comes down to, oh man, I wish I had my notes here, but I believe it's three things. You have to buy the stock at a reasonable price, which means it has to have a higher free cash flow yield than what the 10-year bond is yielding, because you have to be getting a higher return for risk. So you have to buy the stock at a decent price. And the second thing was it has to have a long-term moat. If the business does not have a long-term moat, then it doesn't have a margin of safety. Because if you're buying the stock at a free cash flow yield of like 5%, let's say, which is around what Google is selling for right now, if that company can grow its free cash flow over the next 10 years, then your free cash flow yield on cost is going to increase to like 10, 15, 20%, which is where your margin of safety comes from. So if a business does not have a moat and you don't know if that free cash flow yield is going to increase in the future, then you don't have a margin of safety. What if the free cash flow yield drops down to 1% and it's below a bond? No one's going to want that stock. Like, so yeah, like margin of safety and moats, I've come to realize are so dang important when you're investing for the long term. It's like a moat literally it's one of the key aspects of a margin of safety. So it has to have one.
I feel like that would be a great video idea for the Stock Unlock channel. I know I'd enjoy watching that, kind of seeing a methodical, almost math-driven approach you could take using RTCF calculator and things like that, of what is some very light mathematical formula you can use that you can tweak on your own to kind of answer this question using, core fundamentals. What is the margin of safety? And as we're wrapping up here, I'm going to, hopefully you guys can see this, but if not, I'll send the name in. That might be reversed backwards, but what I'm showing you right now is a book, which I think is a really good value nugget to leave a lot of you with. So the book Daniel was just talking about, The Intelligent Investor, it's a classic. I'm not trying to compare these two books, but another book in the financial world right now is $1 Trillion Triage. $1 Trillion Triage was written and published within the past year. And it talks a lot about the US Fed and what happened during COVID and kind of relationship with interest rates, Powell, and all the decisions that were made to kind of get the US and global economy like through what just happened. So a little bit off topic from more core fundamental investing, but if you guys are into finance like we are, I highly recommend, Daniel, I know I've been showing you that one too, $1 Trillion Triage. I was able to download it for free from the New York State Public Library on an audiobook. It was very insightful for people that want to learn a little more about that. We should probably have a book list or a book channel too in the Stock Unlock Discord, but maybe we'll get there.
I agree. That would be good. But Yeah, it's a good idea to make a video on margin of safety because it's like really important. And there's three things. I forget what the third one is right now, but yeah, basically you gotta have these three things to make sure that you got a margin of safety when you're investing. Oh, the third one is just holding long term. Don't succumb to volatility. Do not be a victim of volatility.
Diamond hands?
Diamond hands. As long as the business is high quality and has a moat. If it does not, then you might have to do something there. But yeah, I think we're over an hour. We got a comment on our last live stream because it went over 2 hours, and people sound like they wanted to cap it at an hour. So maybe this is a good time to wrap it up, Jake.
Yeah. And there's no shortage of code to be written for Stock Unlock. So again, last shameless plug. If you do not have an account on Stock Unlock, it's free to make one. We are co-founders of this business, and our mission is to provide everyone with investment education and analysis tools that we find are ignored by everyone. We're bringing investing back to its roots. If you like it, we do charge a low monthly subscription rate, which you do not have to pay for your free trial, obviously. And you could always hit us up at support@stockunlock.com, comment on our YouTube channel, join the Discord. We're friendly and just huge investing and math nerds over here. So we really appreciate everyone coming out, all the positive chats, all the interaction. It really continues to drive us just to build products for you guys. And, we are doing this full time, which is obviously a huge sacrifice for everyone. And there's nothing myself would rather be doing. So we just can't, express our appreciation for everyone who's been hanging out in the stream. And we're going to be doing this every week. Next Saturday, 12:30, 1 hour cat, Jake and Daniel live. I promise not as many puns, but I can't promise they will be any better than this week.
I think we should try and get Nick on here.
I would love to get Nick on here. Let's try to convince him this week.
Anyways, thank you everyone for tuning in. Really appreciate it. Love all the comments. Love talking to all of you. And thank you guys so much for using Stock Unlock and allowing us to seriously chase our dreams of just providing financial education and true long-term fundamental investing to the market, which is what we need. So thank you all so much for being here. We'll see you next week. And if you want to talk to us throughout the week, come and join the Discord or stay up to date with our YouTube channel, and we will respond to you. Promise. So thank you guys so much for watching, and we'll see you next week. Have a good weekend, and have a great week.
Goodbye. Now I figure out how to end the stream.